Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, April 10th, 2024. It's 10:01 Eastern Time, so I'm starting the video, so we're only a half hour into the trading day, and figured I'd get my thoughts out to you. We've seen some movement in the market, pre-market, futures drop, treasuries, big movement in treasuries. So I just want to talk on that and kind of highlight a few things, and we'll keep this one relatively brief. I did a more detailed video yesterday. So we had our CPI out this morning. That's again, you can access the economic calendar on the site under resources, top menu of the site. Go in there. Came in as expected, hotter than expected. If that sounds like an oxymoron, I covered it yesterday. My expectation it would come in hotter than expected for the reasons covered yesterday's video, and it came in hotter than expected, meaning everyone consensus expectations. And really not by a whole lot, but it doesn't take much right now because again, it's you're hearing the buzzword sticky inflation. And tomorrow you're going to watch for two things. You have jobless claims. Ironically, the market will cheer a weak jobs report, most likely. But here's the thing. I've covered this many times. I didn't cue this chart up, but the job market, the jobs market is at the unemployment's at the historical low rates. And I've showed you many times, and you can pull this yourself, Google it, go to macro trends or one of those sites that'll show it. And that's where all recessions and big bear markets start, from those lows. And when the thing is, when it turns quick. And when the trend change, it tends to stay changed. In other words, when you get down to those historic low end of the ranges, and again, if you haven't seen that, it's in some of the recent videos. You might even have that chart open on a window. Hold on one sec. No, I don't. I saw I had a Fed window open. That's the St. Louis Fed. A lot of great charts there. It's a great resource for economic indicators and other things. But this one I had up, and I'll just share it with you. I looked at it a few days ago. I was curious because it's tax time, right? Everyone's working on their taxes now or having their accountant do it or scrambling to get everything to them. It's another chart that I just decided to pull. Haven't heard it talked about, but look at that huge drop off in tax receipts. And okay, all right, Randy, you're just making your case. We're going to head into a recession. Yeah, that's the thing about these charts. There's just so many. If you look at the ones that really matter, I've talked about this. It's the market has been just blindly following some of the most flawed economic indicators, such as the economic, the jobs data, using the flawed birth death model and all this other stuff. That's probably once it comes out, where those how wrong those numbers have been. It's going to be this market's it's got a lot of hot air in it. But here's, you can see these shaded lines are recessions. Here, let's take it a little tighter. Let's go to 10 years. No, okay, you got the max. You can see here. I can pull it this way. We'll go like that real quick because we don't care about the 1950s. I mean, it matters, but let's go into this period here, modern history. Most of you alive today or quite a few were alive back here. And there's recessions in the gray areas, and especially in recent years. For probably the majority listening to my voice, myself included, my professional career, my adult form, this is the first real bear market we had in the for me. I was stockbroker back then, and that was the recession in the dot-com bubble where the Nasdaq fell 78%. The S&P 500 didn't, and you can see too, you had this turn and tax receipts were starting to roll over. And then the recession hit. Here again, 2008. These are the last two true bear markets. The one we're in now is one, but it's just the first leg down, I believe. And again, I'm speaking collectively of all stocks, not just any one index that happened to be making a slightly higher high. And you can see here, you've seen the income tax receipts roll down. You even saw it when COVID hit. And COVID was my nickname for COVID, or the bear market then, was Ursa Interruptus. It was a bear market. It was 36% down in the S&P 500 in 6 weeks. Fed came in with the nuclear response. So, by that metric, you want to call it a bear market, whatever. I just call it a bear market interrupted. That's my slang made up term for it, Ursa interruptus. All right, so there it is, and you can see tax receipts already peaked and starting to roll, and that was maybe you want to say concurrent, that data point, but here there's just that's a big drop off there. Anyways, and what it does, guys, is it doesn't affect your current position in QQQ or SOXX or pretty much anything, but it might. If for me, it helps formulate the big picture. Where are we going? So when do I start looking for, tradable bottoms and the next, once we get the next move down, which I'm currently positioned for and looking to add to, when am I going to reverse that? And maybe in 401k type money where I tuck it away for a multi-month rally, maybe even the next bull market. And I can just tell you, we haven't even seen the trough, the bottom of the current bear market that started back in 2022, beginning of 2022, late 2021. That's my opinion based on a lot of these indicators here. All right, I just wanted to share that one. Sorry, I don't have the jobs up, but let me go back to that and talk about that real quick. So on the economic calendar, you do have jobless claims being reported tomorrow. This one's going to be big, like I said, right now, and I've been talking about for hyper focus on rates, covering those, my zones on IEF, the 10-year Treasury, and crude oil, and that's everything right now for the market. You saw this huge slide in pre-market today when the numbers came out on the CPI, hotter than expected, and again, it was just a tick higher instead of 0.3, and on all categories, core and all data, it was 0.4, I think. But this one will be tomorrow. This is the PPI, Producer Price Index. This is also an inflationary gauge. It's the inflation at the cost level of producers, and it has the potential to move the markets as well. Most certainly will. There's your numbers. And here's what I recommend if you're if you're kind of new to investing, trading. I very much incorporate, as I've been talking about, fundamental analysis goes into my longer term outlook. It's going to be the charts, the technical analysis at times, how I'm positioned. And I say that often. I might speak the bearish or bullish speak on one particular commodity for months, even years. But that doesn't mean I'm positioned in it. And, I wait for my buy and sell signals, and that's what the chart will give you. But if you want to read up on this a little bit here, go down to the definition and then click on this Why Investors Care. So it tells you what the PPI is all about, why it matters. They have some great explanations in these things here. And then at the end of the day, it tells you how it's made up, how it now includes services where it used to not include services, blah, 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 blah. It's all in there. And then, bottom line is the bond market rallies when PPI decreases or posts only small increases. And so, the more accurate way to say that is, I don't think that statement is written as accurate. It's the bond market's going to rally if the PPI is cooler, it comes in below expectations. Is pretty much what you see there, and vice versa. Actually, yeah. So if the PPI comes in below expectations, that means okay, inflation's not so bad. And here's the thing: we're in a hunky, what do you call it? A kind of a quirky little environment right now with these hot inflation numbers, where again, I've talked about this, good news is bad news, or bad news is actually good news. That's really what the market's mantra has been for a while now, and it's taken good news on face value. So, and that's the whole supporting the recent trend that, we've, lately it's been sideways, but leading up to that. So either way, we'll watch that. Now I can tell you just right now that a hot PPI cannot and will not, should not be bullish at all for the market. It should send yields further higher, should send bond prices down, and just again, something to watch tomorrow. It's not the be all end all. And I always say at the end of the day, what's most important is the market's reaction to those things. So here's IEF, the 10-year, huge slide. This was when the CPI came out. And again, it was a tick higher. 0.1%. That's the smallest increment they even measured in. But look what it did to IEF. It just smacked it down. This is a 1-minute chart in pre-market. Futures, you'd see a clear thing. IEF doesn't. It's a bond ETF. Most professionals and traders, myself, we trade the ZN, the Treasury, 10-year Treasury futures, or ZB, or whatever, the Ultra Bond, whatever you want to trade. Let me turn that. Oh, well, I'll just jump over here. All right, let's talk about where we are. That's most important. Here we will keep going lower, lower, lower. Those divergences so far have not played out. As I mentioned, they're still there. I want to reiterate that now. So there's still the potential they could play out. But it's, to me, very bearish, and I've seen it before. When you have positive divergences that fail to materialize and play out. In other words, the indicators keep going lower, lower, lower with prices, and eventually at some point, and that point will be when you take out these previous lows and you no longer have the positive divergences. Get out of Dodge time for the stock market. My levels, we've been painting by numbers, or trading by colors is what I call it lately. I've made this as simple as I think I could for an investor, swing trader, and giving you these zones on especially the 10-year, but as well as crude oil. And that's it. So what happened today? Well, we saw the biggest drop in futures in a long time. I'll go to that in a second on QQQ. And that was because we took out support. Remember, I had 92.76 as a support level in my orange zone here. And so we just made a new multi-month low in IEF. That means a new multi-month high in yields on prices. And what happened to the stock market because of it? Here's a 1-minute chart. That was this morning. Some fools or algos bought the hot CPI initially. You can see a spike up. I'd hate to be that person. And then boom, from there it dropped 2.23% in a matter of minutes there. That's a pretty big move. And again, it shows you what I've been talking about, this hypersensitivity, and it just goes back to that IEF chart. The deeper you get into the zone, the more it matters. I said they're not, binary levels where, market's going to crater. It's incremental, meaning each tick lower into those territories. And it's also a function of time. The longer you remain in any of these zones, the more bearish that is. And that is because, and I've heard this to the point where I almost want to puke in my mouth if I hear it again. The bull case that, the lag effect doesn't matter anymore. The economy can absorb these rates, and it shows you this is just a normal rate. No. It's called the lag effect. It is real. The business cycle hasn't been repealed. We know there is a massive amount of debt out there, both consumer and business debt, that needs to be and will be rolled over. It has to be. It has maturities. Some of them also have, many companies as well as individuals have variable rate debt. So they're starting to see those rates reset and go up, like a variable rate mortgage or other variable rate loans. Businesses are big on that too. And so, so it's a function of this. Or this, let's just say 3 months from now, we're still sitting here in the orange or red zone. That would probably be worse than just doing this right now. This would correct the market and then shoot up here, an abatement in yields. The market, for longer term, for 401k type stuff, that would be the better scenario for the market to hit my red zone and then get back up in the green zone. Whereas if we just stayed here, that's not going to be good. So that's it, guys. We're down today. And now let's just talk on QQQ, and then I'll give you a few trade ideas, and we'll leave it at that. Trade updates and new trade ideas. QQQ. Remember, QQQ, we traded off the 15-minute chart. It is both, it's a swing trade, but it's both. Remember, this swing trade was already completed. We already hit in pre-market. You don't see it here. We already hit the bottom of the zone. So when the day after the Fed meeting, we shorted the highs right there with I'd say the active trader could do a quick pullback trade. I give you all the targets. Some of these levels have since been modified based on where the reaction points are. But we had that quick pullback trade, and the swing trade was hit there. So that one, and I started talking about on the way down, saying that my expectation was not only that we'd get there, I wouldn't have listed that as the target, but if we did get there, we'd most likely go down. We're going to ultimately go down through there. So I listed as both a swing trade with that quick, 3.5%? Believe me, nothing big. But I also then gave you as early on targets on the daily chart and said, if we get there, you might want to just ride it out as a swing, longer term, typical swing trader, meaning position for, when I say a typical swing trader, I'm referring to trades. That's what most of the trades on the site are about, measured in holding periods, measured in usually several weeks to several months. That's the range. That's a typical swing trade. And then active swing trading, those trades are measured in usually days to maybe a few weeks. And so this was more of an active swing trade. It took us, we got down there, and that was a matter of 14 calendar days. So less traded in days, it was fewer than that. So 2 weeks took us from the post-Fed pop to get down to the bottom. And again, we hit it, and you can see it too when I go to my futures. I'll go here, NQ. This is that yellow level right here. The yellow line is that comparable level to the bottom of the trading range, roughly 433 on QQQ that I've been highlighting. This is that same box. This is my 60-minute chart. And so that's when we hit it right there. And then we had this bounce. And so this is up to date. Just keep in mind these this platform shadows through when I start creating annotations on different time frames. They all start going together. The trend lines remain on the time frame I put them, but it drives me crazy. So forget about some of these divergent lows may have happened on the 15-minute chart, and some like this recent one here was only RSI divergence, just like that one down there last time we hit second to last time we hit the bottom of the range. But I want to point that out. So effectively that QQQ trade has already been hit that target. And then, like always, you get a reaction, support. I just wanted to say that right now, look, anything's possible. We hit the bottom of the range. We may go to the top, but look, something's happened. Last time we hit it, we went as far as this downtrend line. So this is a significant level. If you're looking, if you are currently short or looking to short today or anytime soon, or you're a bull, okay, this is a significant trend line, this downtrend line off that post-Fed high that we shorted. And so pop above that is going to be technically significant as well. You have a reaction high there. So somewhere right around there above that reaction high, that's a good place for a stop, or for a long side trader to maybe start scaling into a long position and adding on a breakout above. And then of course a short seller won't want to see us go much above that level. Only thing that could be bearish, and it will only be known in hindsight if we break out and then that breakout fails and we start heading back into the range, and we still have divergence. I'd want to see that as well, but I don't think that's going to happen. I'm just showing you levels. What I think is this is it, and this is why I'm doing the video. I would take advantage, short any rally into resistance right now. Again, it depends. I'm speaking blank slate, and that's what I often do, and I know it can get confusing. What am I talking about? If you've been building, or start a short position, like here, for example, for the longer term trade, and you have your allotment, and your trading plan is not to go to full position or add to that until the bottom of the range, which is about 1800 here in NQ and about 433 in QQQ. Let me go back to QQQ since I know a lot of traders, that's what they use. So if that's your plan, then stick with it. So when I talk about objective short entries, it doesn't mean you can't keep adding every time or an objective long entry on, natural gas or whatever we're trading right now long. You can't keep adding each and every time. Or you eventually add all your money, and then what would you do? Start borrowing money, leverage, take a second mortgage on your house? No. So I'm speaking to objective entry points, and I'm talking there's a myriad of ways to trade, especially even with my analysis. Active trading, you can game the zigs and zags off support resistance. You can use 15-minute charts, divergences, overbought, oversold conditions, candlestick reversals, all that kind of good stuff that active traders can use. But I did want to reiterate that I think that's it. I think the next time we get down to 433, it's going to give way, and I think it's going to give way soon. And I can just say now, based on what I'm seeing with IEF, this is what I wanted to just kind of drive home today. The fact that we're down here even deeper, we just made it a new low into my orange zone, tells me at this point there's damage being inflicted. Bulls are starting to wake up to the fact that, oh my God, well, we were going to get 6 rate cuts this year. Oh, now we're going to get 3. And now let me talk on that. Now look at this. Check this out. CME rate watch tool. Where do we go here? Okay. This is, let me refresh the page. Well, I'll refresh it in a second, show you. Okay, so this is a great tool. It's called the CME FedWatch tool. You can Google that and it'll take you there. And it's based basically on futures, Fed funds futures. I've traded those in the past. I posted a couple trade ideas on them. That's where the smart money, most of I guarantee you talk to your neighbor, even if your neighbor has a Robinhood account, they probably have never traded or don't even know what Fed fund futures are. But so this is the smart money. These are the bets in Wall Street. This is what they talk about when they talk about the probability of a rate cut. It's this. It's based on people putting their money where their mouth is. It's not like some kind of a sentiment poll. Hey, where do you think rates are going? These are people betting cold hard cash on futures. So it's a pretty accurate indicator. Now, boy, it just flopped today. I didn't have the previous numbers. This is the May meeting. We already knew the May meeting was off the table. This is June right here. Let me see. I'll refresh the page. Okay, so here's how you use it. Wow, look at that. The current target rate is 5.25 to 5.5. This is in basis points. They don't put the period. Basis point is 1/100%. So 5.25 to 5.50 means 5.2 to 5.5%. That's the current Fed funds rate. And so the way you use this tool is down here on the bottom. You look at what the rate is. So that is the current rate. So this means no change. This would be a cut right here. Here's your cut. Because if you go from 5.25 to 5.25 to 5.50 down to 5.25, that's a quarter point. We just saw this plunge today. In other words, they just took the June rate cut off the table. How much more can the case that's been predicated on this market rallying? And look, guys, I still think we're going to get a cut. The June's been taken off the table. It's not all the way off the table. But all along I've been making a strong case that we're going to see a cut for reasons that the bullish case, those citing the bullish case in 2024 with stocks ending the year higher, they're looking at other things than I am. I'm looking at it. You're going to see, I believe, these economic indicators roll over. And I'll do another video soon. I did one not too long ago that was just focused on economic indicators. And there's a lot of them out there. Leading indicators I talk about, the ones that really, you can dig down. Quite a few of them are obscure. They're not really, you don't see them much on CNBC. But they have very accurate track records, and a lot of those have been rolling over. So, all right, that's it. I just want to show you that this pretty much shows you that the chance for the June cut now has been taken off the. I'm sorry, I'm still in May. My bad, guys. I thought it clicked. There it is. The June cut now has dropped down to 18.5%. May was off the table already. But this is what shot up. So now there's an 81% chance of no cut, and only an 18.5% of a quarter point, and a 0.5% chance of a 0.5% cut. You don't want that. If you got that, it would be because there's something breaking in the financial system, and so there's a still a 0.5% chance of that. That would be, another problem with a big, the banks or big financial institution or stock market crashing or something along those lines. All right, that's that. And so where do we go with that? I know a lot of you don't trade bonds. And, I put it out as trade ideas. I'll trade them at times. I've even mentioned as a hedge. And if you did that, then look, if you were short, the two things I've been talking about being, shorting and being short are IWM and QQQ. IWM, small caps are down 2%. So let's just say you had hedged up with IEF and you took a 2-time position. That's an offsetting hedge. So you didn't, it protected you today. If the numbers came in softer, small caps would have been up because they're the most rate sensitive, but so would have the bonds. And so it's an indirect hedge, and it's working, almost perfectly on IWM. And then QQQ, where we at? Yeah, same thing. QQQ is down about 1%. And so is IEF, and you'd actually, in that case, no, you'd be down a little more in IEF again. So that's if you want to take it, and it still works right now. Look, there's a divergence. Maybe the Fed's going to pull some rabbit out of their hat. There's talks about them stopping QT, and something like that would certainly send the bond market shooting up. Oh, by the way, one more thing, guys. Economic calendar today has we have the 10-year bond auction. So Little Miss Yellen, former Fed chairman, many of you will probably remember, who's now in charge of the Treasury. It's obviously been a revolving door forever. The Treasury and the Fed, and Washington and the Fed, they have a 10-year their 10-year note auction. What I was getting at is she's been financing our debt, and that's the other thing. That's just all intertwines. I could talk on it forever. You probably hear if you watch, read up on this stuff or watch the media. They talk about it. Our massive debt in the U.S. We're running a wartime deficit for the first time in history. Our deficit, compared to our GDP, is at wartime spending levels. You've got the current administration now. Biden wants to trying to once again forgive student debt, and so this is just unseen. We're stimulating. There's government stimulus and spending as if we're in a recession or a war. And so, God forbid, what happens if the economy really does turn into recession? And the problem here is the bond vigilantes are going to keep this thing in check here. Who's going to buy? Let's see how that 10-year goes today. Show just coming out later today. But who wants to keep taking on federal debt? Because our interest expense already is soaring. I've heard the numbers, it's staggering. And remember, the lower the 10-year bond goes, that means the higher the yields go. We have to then roll over. The U.S. is continually rolling over debt. That's how we finance our operations. That's how our troops are paid. That's how Social Security is. Everything is based on, we have these tax receipts that come in. I just showed you, which are dropping. Clearly showed you that earlier. And now you have these bonds that come and due. And the problem is Yellen is playing a game of a dangerous game, has been, by rolling the debt over the low end to short-term bonds, mostly. And that worked great. It was predicated just like the stock market bulls, saying that rates were done. This is TNX. This is the 10-year. They said, oh, that was it, and we're going to go back down, and rates are going to continue to fall. Well, guess what? The opposite happened. Something I talked about all along. The charts were saying it. And so this happened. Okay, so the only way out, if this happens, great for great for should be net positive for the stock market, like I said, unless the market's crashing. But if rates continue to stay high, just roll this back. Let's just go back long term. Here's a weekly chart. See, this is what rates have been moving lower and lower and lower. And Fed, certainly, Yellen, nobody thought they'd be here. And now, as I've talked about before, and this is very important, the Fed doesn't control the long-term, the 10-year Treasury bond. Those rates are set at market. And the only way out, if this keeps going up, not only does it balloon our deficit because they're rolling treasuries at higher and higher rates and you happen to pay a tremendous amount of interest expense. It's already a lot of countries have already cut back on buying U.S. treasuries, and they know that. The only way out of it, we're just going to have to print more money, and that's technical default. Sell new bonds, create new bonds out of thin air, print new money to finance our deficit. So it's bad. It's ugly if that happens. And I don't know. I think over time rates are going higher. I do think we'll probably see 5% again soon on the 10-year. And remember, I covered the other day, one thing that was important is this PPO indicator. It's still testing that zero line. And as I've told you before, I covered this in a video last week, I believe it was, when you're above the zero line, the PPO here, the trend in treasuries is bullish. Cross below, then the trend is bearish, and the Treasury yields. And so that line also tends to act as support when tested from above, and it just got tested from above. So either way, watch it. You may or may not agree with my outlooks on the market, but I don't think you can argue with my logic on bonds. And it's more of a, like I say, you can call prediction, but more of a, hey, watch and then react, because the higher yields go, the more bearish it is for the market. You saw that today in one fell swoop. Big drop in Treasury yields. Bond prices spike up in yields, and the stock market concurrently fell. And so that brings us back to my point is, we're down here. This is not no bueno. We get back up here, we start moving the yellow zone. That's still better than here, but not great. Unless we get back in the green zone, and unless it's for the right reasons, meaning if the stock market were to crash, and it only crashes when nobody thinks it's going to crash, by the way. Rarely, you don't get a crash. Very few have to see it coming. I think the odds of a crash this year are high as I've ever seen them. We'll see. There's still some levels that need to be taken out. I'm going to get to that in a second. So just remember, if this happens, it's a flight to safety bid. If the stock market's rolling over, economic indicators are rolling over, future growth expectations, hence future inflation expectations would be going down, which would cause treasuries to go up, and that is not a bullish scenario. So that's that caveat I keep putting in there. But other than that, if things are just for normal reasons like today, natural market forces, inflation, bad for the stock market, and obviously really bad if we get down there. Okay, let's talk where we're at. It's kind of a state of the markets thing. Remember, QQQ 433 is my big number. That is right here. What happened here? Oh, got to zoom in. I'm too tight. 433 right there. 50-day moving average is just below. That should be, in my opinion, especially if it's a solid move through there, lights out for the market. And, what I do as well for you, try to tell you my expectation of how things might look. And I think it'll be a pretty quick swoon down if we take that level out with conviction. I gave you on another board here. There it is, price targets. Told you I'd have very little interest if that happens to gain many bounces off the early targets. I just think we'll head down here pretty quickly to T4, and that's still from, I did last time I covered that was yesterday, and that was a 10.5% drop. Now we're another percent there, but not there yet. 433 needs to go, and then my degree of confidence goes up. But right now it's gone up just based on those hotter than expected CPI numbers. We'll see what PPI and employment bring tomorrow. XLK, my big level has been and remains about 204. Same thing, we're in this trading range. This is a near mirror image of QQQ. It is below trend. We have broken down below the trend lines, both the primary and the benefit of the doubt, back tested, but we need to break that, and that's kind of the last thing I'm waiting for on XLK, and that is the top sector. So I'm about to cover the other three largest behind it, but this one's about a quarter of the S&P 500, about half or over half of the NASDAQ 100. So this one matters more than the next two combined, at least. This one I told you recently, we already got a sell signal. My yellow line was at 144.55. It's the bottom of the trading range. First, we broke down below the trend line, had a little kickback rally. And so XLV, healthcare sector, the second largest in the S&P 500. That's a check mark. That is on a sell signal. That is an active short if you want to be short XLV or any of the healthcare stocks. 16% weighting. Again, I haven't updated this in a year or so, but XLF, third largest sector in the S&P 500, put in a divergent high and a bearish engulfing candle right here. That is a topping pattern followed by a breakdown of my BOD or benefit of the doubt trend line when I have two trend lines in close proximity. This one broke down, back tested, but we had that post FOMC whipsaw. Still a backtest rejection, and then my benefit of the doubt when I can draw two trend lines. That white one came in there, that got taken out, and then boom, what I like to see is solid red candle, and still looking for a move below 40, 50-ish, and there's that 50-day moving average. That will seal the deal. So that's the third largest, kind of a partial check mark if you want to call it, but again, my yellow levels just increase the odds, guys. This isn't, again, these things aren't sell signal. To some might be binary. If something's above something, it's on a buy signal, something below something on a sell signal. No, my analysis is a little more complex, but I'm keeping it pretty simple. I've stopped even highlighting the bottom four sectors of the S&P 500 or 5 or 6 because they don't matter. Their weighting doesn't move the needle. Real estate, basic materials, they matter in other ways. Basic materials, obviously inflationary, energy, and I talked about that too. I said, look, those are the most bullish sectors, is energy and basic materials, and that's inflationary, and that's another feather in the cap for the bearish case. So there it is. We're very close. We already had a breakdown of my primary trend line right here. Breakdown, back test, rejection, and we just need to take out 177.52 to put XLY on a sell signal as well. So slowly but surely getting my check mark, starting with, IEF, the 10-year Treasury, starting with crude oil, going into my orange zone. We just need really QQQ to break. Because when QQQ breaks, Nvidia's broken, Apple already broke. We've already broken some of the former Mag 7 stocks. We just need the rest: Google, Microsoft, Meta, and pretty much Nvidia. Which brings me to that. I gave you an update yesterday. We're still flirting with that key support. Remember my yellow line, or not yellow, my first and significant support level right here is 840. Yellow line still at 742. But when 840 goes, remember I highlighted it yesterday. I said, look, we're below it now. We're breaking it, but it's a daily chart. So what happened? They didn't get the daily close below it. They tested 840 again and bought it up again. So this shows you that, again, agree with me, disagree. It shows I'm right on my, and that's what I believe my skill set lies, identifying key support and resistance levels and then what may happen when they're taken out. And you can see the buyers are stepping in buying 840. So the fact that line was put here before we even got there yesterday and they bought it, and again they bought it today at the lows as a green candle, we hit it and bounced, it shows it's technically significant. So if that breaks, my expectation, there are no guarantees, especially on a daily closing basis, should open the door to my next support slash 742 target, then the trend line. And then if that goes, you don't want to be long stocks or semiconductors or anything tech related. And ultimately, I think it will go this year. But first things first, guys. And we could bounce here and we could go up for 3 or 4 months. And guess what? You're going to say, Randy, you said we go up. Look, we don't break 840. We're not going down here. That's that simple. And if we go up anymore, anytime soon, something comes in, Fed announces, we're going to stop quantitative tightening, something sparks a rally. All I can tell you definitively is Nvidia, the most important stock right now in the market, in my opinion, more so than Apple or anything else, is at support. And it's at good support. The buyers keep buying it. QQQ is at and remains above, keeps testing the bottom of my key trading range, 433 and the 50-day moving average, and it's above it. So all I can tell you is the market's at and still holding above key support. And so therefore you can't get, in my opinion, you can't get aggressively bearish or short. If you are bullish, and I've said this many times, I know there's some on there, then you can buy pullbacks to 433 with stops somewhat below. If you're positioning for higher highs in the market, you can also buy a breakout above the top of the range. It's that simple. Okay. But like I said, these kind of red flags, including Treasury yields and crude oil and other things I'm talking about, are putting some pressure on that. Let's see. I might stop the video here because it's getting a little bit long. I've gone over quite a bit of some of the things I like lately. Oh, here, I'll do this. I had a couple alerts fire off this morning, but remember, so far the market, they're buying it up. We hit the bottom of the range in pre-market again, roughly. I just showed you on NQ. Yep, showed you right there. 1800, that's the bottom of the range. That means the futures are around the clock, so that shows you pre-market. So once again, Pavlov's dogs do what they do. They buy the dip, and that's trading 101, and they're buying pullbacks of support, which are certainly objective. So if you take anything from what I'm saying here, if you shorted that move down this morning, if you waited till the CPI came out and then you shorted, you're trading contrary to the game. I used that analogy before. My wife and I, was before we were married, we're down in the Bahamas on vacation. We were in our early 20s and sat at the blackjack table. And this was what's now that Atlantis. It used to be back then when we went, it was a Merv Griffin-owned casino. And I didn't know the first thing about blackjack. I just knew you got to try to get to 21. And I'm playing there, and I'm just bleeding cash. And the Bahamian dealer, I see he doesn't even look us in the eye. He's looking straight ahead. He's probably, his pit boss is probably watching him. I hear him say something. He says, "You're playing contrary to the game, man." And I'm like, "What? What? You're playing contrary to the game." So he was telling me, and that's my best Bahamian accent, that I was playing contrary to the game. And I immediately recognized that, gave him a big fat tip, and walked away from the table. So what I'm trying to get at in trading, if you felt like shorting that today, well, you just shorted a move down to support. The only trade to be made this morning at the low, once the future spiked, was to buy, because you hit major support where they've been buying now on every single tag of it, going back here, and that's in February, since February. Boom, 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 and boom. Okay, so the only trade to be made today was to go long. Again, not that, look, this thing's going to crack. I'm going to tell you, I didn't go long. I'm sitting tight. But the next trade, you can now short. We're at resistance. You can see my 18,240 level right now as I do this video. And fortunately, it's the end of the video. So by the time you get there, we're probably going to have done this. I think we're going to do that. And I think we're going to do it very soon. But unless we do. So these are your two objective short entries here, right now, on a rally into resistance, or if we go up higher and you rally back into that same trend line. We've had multiple reactions so far. Above there, I would not add to any more shorts or initiate any shorts. I would sit tight and maybe have your stops either there or above there, or you short a break of 1800. Those are your objective short entries. Bulls, you can do all that in reverse. I just told you, buy the breakout above the trend line, buy the breakout above the top of the range, buy support. I just wanted to go over some of the alerts. I got two today. I got AJG. That's Arthur Gallagher and Company. And that one just broke the trend line. Now look, it's a daily chart. They could rally this up, but as of now we're below there. So typically I'll take those on faith. Short it if they recover back, a solid recovery back above the trend line. Or here, I'll tell you what, let me give you a level right here. Here's a downtrend line right here. So this is an objective short entry now. I'm making an official trade, I'll call it. I'm calling it down to at least 219, that's 220 with the first stop here, about 228. That would give you, and there's the 200-day moving averages. That's going to be a 4% drop, then an 8% to my second target, and then I think we'll get down here ultimately, and that's about a 15.5% drop to 202.38. And then if we rally back and close solidly above the trend line, I would give it a stop a little bit above right here, this candle, yesterday's high, because that will take us above the downtrend line, or it'll put us back above there. So that you're giving yourself, you short it here, you're giving yourself a 3% stop, not even 3% stop loss to make as much as 15%. That's a phenomenal RR 5-to-1. Even if you're only targeting this target, you're still looking at better than a 2.5% or so RR risk reward ratio. Nice trade. Airbnb, I got an alert on that today too. Also below trend line, still below it now, objective short. I'll call this first. It's just a rough level support. I would target this one down to right here, right to the 200-day moving averages, and about 141.17 is price support as well. So there's my current target right there, sold target, minimum target, and that's 11% drop. AMP, I highlighted that one yesterday. It broke down, still below the trend line today. In fact, it's back testing, so it's about exactly where it was yesterday. That's also an objective short. Calling that one down to, I'm calling a lot of things back to their 200-day moving averages, guys. So, that's, minimum, this one's got about 10% downside to it. And therefore, your stop can be 3% or something above where we're at right now. That one was triggered yesterday. MDY, I was doing a video the other day when that one triggered a price alert. It was an intraday break, but now we're clearly below. This is the mid-cap sector right here, guys, the mid-cap ETF. Clearly broken down as well. And we already know the small caps. I've been highlighting the breakdown and back test and that 208.50, which again is the bottom of the big trading range when the small caps topped a couple years ago. Great objective level. All they have to do now, and they tested that. Remember, this is my yellow level where it's lights out, I believe, for the smallies, 199.70. Look at that. What we hit today to the button. And so the same thing, just like QQQ. We're testing support, and we just need to pretty much take out today's pre-market lows and everything. And I think we're going to do it just like QQQ. We have resistance here, probably better on a 60-minute chart. There it is. So the smallies are an objective short now. They weren't this morning because we were at support. That support I just showed you on the daily chart. I'll put this line up to match it. It's right there about 199.60. So resistance there and a big old gap just above. And you also have a downtrend line coming off the highs. So this is where you can shorting zone or below there. Targets, looking at a pretty major top. So I'm going to give you targets now if you want them. Let's just see if we get some traction. We break these again. At least we're coming back down to the 200s, and we go 190. You can see 193.10. That's my next stop for the smallies, IWM or RTY, Russell futures. All right, guys, I got to wrap it up here. As you see, you get me talking about the markets. I'll just go on and on and on. But I'll work on some new. There's a lot of individual stocks and sectors out there, and I've highlighted quite a few recently: restaurant stocks, home builders, semis. There's just a lot of individual stocks and sectors that you can outperform, do a lot better than the market. When you short an index or go long an index, IWM, QQQ, you're going long or short the best, the most bullish out of 100, or even in this case, almost 2,000 stocks. Long or short. So you have the safety in numbers kind of thing. But again, you can, I can, put me on the right side of the trend, and I'll vastly outperform the indexes, with individual stock and sector selection. And so I'll continue to highlight those. For those of you that are inclined, it takes a little more time and effort to, do that. And, and you need to be a little more diversified because you have to navigate earnings and stuff like that. But at least earnings season is out of the way right now. All right, let me stop here, get the video out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.